How important is it for people to understand that, okay, we can borrow and buy this property now on these incomes, but really understand what it looks like for when they go back as well?
Okay, really good, really good point. So this sort of strategy comes into looking at your short-term cash flows and your medium and your long-term cash flows. So in short-term cash flows, yes, you can afford the property. You've got a tenant in there who's renting the house, giving you some rental income, and as a result, you're paying some outgoing costs, interest, land tax, council rates, repairs and maintenance, etc. That they're all achievable and will give you some nice tax credits or tax losses to carry forward. Now, when you're looking into a situation where you're about to return back to Australia, as soon as you return to Australia and move back into that property, the interest on the property becomes non-tax deductible. So as soon as that happens, that interest becomes a lot more expensive, because when you're in Australia, you need to earn $1 of income, you need to pay tax on that, and then you need to pay the mortgage. So something like a 6% mortgage might actually result in being an effective tax rate more like 9% after you've earned the money. So generally with clients, having a strategy where you can collect cash or collect investments in Singapore or Hong Kong or wherever you're based, and generally you'll be enjoying those investments capital gains tax-free and income tax-free, which is not too bad.
Yes.
And then just before you're about to return to Australia, look to encash those investments and pop those on the mortgage. So you can reduce your mortgage, reduce the amount of interest you're paying, because at that point there it becomes non-tax deductible. You want to maximise your tax credits, tax losses whilst you're whilst you're offshore, and then as soon as you go back, you want to look to reduce that debt as much as possible.
Definitely. I think understanding deductibility of the loan versus non-deductibility when you go back is one of the most important things for people. Especially the conversations I have with clients, they can get very focused on what the interest rate is, but the other consideration for a lot of clients is going interest only versus principal and interest.
Yep.
And for a lot of the clients that I talk to, I need to remind them that, okay, the cost on P&I might be lower, but your cash flow per month to pay that loan is higher. So just understanding how that fits into your budget as an expat, but then obviously when you're not an expat, is a very important thing to consider.
Absolutely agree.
Yeah.
And something that you did a great job of setting up for myself and my wife was an offset account for us, which has been very handy for that.
Yes.
For future planning for us, and also for a lot of my clients, having an offset account is very handy. So with the offset account and basically keeping the loan tax deductible, if you are collecting cash and you'd rather put it against the property, placing it in the offset account as opposed to paying off the loan directly will still reduce your interest. However, it gives you some flexibility going forward. So, in the future, should you want to take that money out of the offset account, that loan remains tax deductible to that property. And let's say there's a change of strategy, which happens to a lot of expats, where they think they're going to go back to a particular house, move into it at a particular time,
Yes.
and then the boss comes knocking and says, hey, we want you in a different country, or we want you in a different state in Australia. And that gives you that flexibility where you can take that money back out of the offset account, use it for something else, and that loan remains tax deductible against the initial property, because the ATO will follow the cash flows.
Yes, I think it might be good to spend a couple of minutes on that, because it's something that I have to demystify for a lot of people. Is tax deductibility on a property is not something you can do retrospectively.
Correct.
So for a loan to be deductible against the property, the loan has to have been used to purchase that property, or if you do improvements for it in future, then you do more borrowing, then that portion of borrowing can be deductible.
Exactly.
As well.
Well summarised, Tim.
Yeah.